Hello everyone, this is Marshall Gittler for Claws and Horns, bringing you the outlook for the week beginning May 29th. I think there are likely to be three major themes this week. First, the market will still be absorbing the results of the OPEC meeting, which was as expected but no better. Oil may remain under pressure during the week, resulting in some downward pressure on the Canadian dollar, Norwegian krone, and the Australian dollar. Secondly, Trump returns home, which means Washington politics will take center stage again. That could prove negative for the dollar if there are any further revelations about the White House connections with Russia. Finally, ahead of the June ECB and FOMC meetings, central bank policy will be in even more focus than usual. ECB board members have been fairly unanimous in saying they won't start raising interest rates before they end quantitative easing. That may reduce expectations for the June meeting and thereby put the euro under some downward pressure. On the other hand, the Fed's almost unanimously expected to raise rates at its meeting. And so the debate there is whether the hike after that will be in September or in December, and how that fits in with the shrinking of the Fed's balance sheet. Now, the likelihood that the Fed may start running down its holdings of bonds and thereby push up long-term interest rates at the same time as it continues to hike short rates could bring the monetary policy divergence play back into sharper focus and support the dollar, particularly against the yen. So as for the data, it's payroll week again. In contrast to last week, when a slew of meetings and many speakers set the tone, this week has no major meetings and is fairly empty of speeches. In this place, there are some important data, most notably the closely watched U.S. non-farm payrolls. Now, the ADP report, which, by the way, comes out on Thursday this week, since Monday's a holiday in the U.S., will be the market's first target. That's the purple bars in this graph. As you can see, the ADP report isn't a great predictor of the non-farm payrolls, the green bar, but it's about the best we have. That's on Thursday. Then comes the NFP figure itself on Friday. It's expected to decline to 176,000 from 211,000, but that's still a tremendous level. Remember that last August, Fed Chair Yellen said rises of 180,000 a month were unsustainable. Yet here we are, 9 months later, still running at around that pace. That should be enough to keep the market confident about another two rate hikes this year, which in any case, as you can see, is already discounted in the market. This shows the implied rate forecast from the Fed funds market. Now, there are several other big indicators out for the U.S. during the week. On Thursday, we get the final market manufacturing PMI, which usually isn't that different from the preliminary version. And we also get the Institute of Supply Management, the ISM version of the PMI. Now, the ISM index has a longer history in the U.S. and is probably more closely watched than the market version. In any event, the ISM index is expected to fall about as much as the market index did, which is just a little bit, but remain at a fairly healthy level. Now, with the manufacturing ISM index comes the prices paid index, sub-index. That's also expected to fall a bit, but remain in really quite elevated territory. That's the purple line in this graph. That implies further inflationary pressures. That should also help to keep rate expectations high. We get the U.S. personal income and spending data out during the week. The rise in average earnings and hours in the monthly employment report for April points to a rise in personal incomes during the month, while a small rise in retail sales suggests a rise in personal spending too. The combination of these could prove supportive for the dollar when they're released on Tuesday. Now, along with the personal income and spending figure comes the personal consumption expenditure deflator, as always. Now, I think it's kind of odd that the market doesn't seem to pay that much attention to this indicator, because this is the Fed's preferred inflation gauge, or more specifically, the core personal consumption expenditure deflator is the Fed's preferred inflation gauge. The CPI just seems to exert some hold in the market. Nonetheless, this is quite important for the Fed's thinking, and the market's expectation is that it will actually show a slowdown in inflationary pressures, both at the headline level and the core figure. That could be negative for the dollar, except that the minutes of the May FOMC meeting suggested the committee members aren't particularly worried about the slowdown in inflation. They seem to be paying much more attention to the risk of overheating in the labor market. For the EU, for the Eurozone, the main point of interest during the week will be the inflation data for Germany and on Tuesday, and for the EU as a whole on Wednesday. All the inflation measures are expected to slow, including the crucial core EU-wide inflation measure, CPI, which is what the ECB seems to be focusing on nowadays. That's the red line in this graph. Lower inflation in the EU could mean a more dovish ECB the following week, and therefore a weaker euro. As I mentioned, this is the week for the final purchasing managers indices, including those from Europe. In addition, the PMIs for countries that don't have preliminary ones will be announced. The first one is China, where the official manufacturing PMI and the Caixin market manufacturing PMI are both expected to show a small slowdown in expectations. Along with other signs of slowing in China that we've seen recently, this could put some pressure on the Australian dollar. For the UK, both the manufacturing and construction PMIs are expected to fall substantially, although the manufacturing PMI is starting from quite a high level. This could put some downward pressure on the pound. Now, Canada announces its monthly GDP figure during the week. It's the only major country I know of with a monthly GDP figure. Growth is expected to slow, which, together with a recent fall in oil, may put the Canadian dollar under some pressure. Now, there are also several important indicators out from Japan, as is usual for the last week of the month, but oddly enough, these don't really seem to have much impact on the yen. I looked at it and they just don't seem to affect the currency. They include the employment data, retail sales, industrial production, and capital investment. And since none of them are particularly market affecting, no graphs. This is Marshall Gittler for Claws and Horns with the outlook for the week of May 29th to June 2nd. Good luck with your trading.